Hi, welcome to Finance of Justus. I'm Justus. With Disney being where it was in 2014, a lot of people are taking Disney as a contrarian play. But there's one issue. Usually on a contrarian play, the numbers say something else than the market. And in this case, the market is kinda actually right with the numbers. Unlike with other contrarian plays that worked out, like Meta, where we had a lot of free cash flow, at Disney there is not a lot of free cash flow right now, and probably will also not be in the future. Usually I like to be on stock analysis for this and show you the numbers here, but for Disney, we need to dig a bit deeper into their numbers. So here we are in the financial release for Disney's third quarter. What is important to know is this right here. The two segments that Disney operates in. Disney Media and Entertainment, which includes their movies, their streaming services, etc. And then we have the Disney Parks Experience, etc., which is all their parks and the cruise lines and stuff like that. And we can already see that despite the parks making up way less of the revenue, they make up a huge chunk of operating income. And also one thing, while the parks are performing great, the media side of the business is struggling. You all know that the parks are just a cash cow. You have seen probably a TikTok or an Instagram reel of a parent complaining, look at how much it costs at Disney, 20 euros for a cola, 1,000 euros for tickets. This is how Disney makes their money. And most of the issues with Disney right now come from the media and entertainment. The parks have been underperforming during the pandemic and a little bit afterwards, but they're basically back to capacity now. They're not the issue in the business. The media and entertainment division is made out of linear and direct to consumer. And we can see linear is just in a constant decline. 7% decline in revenue, and this has been going on for quite some time. It is no wonder people don't pay for cable anymore, they switch to streaming, and the margins here are just way lower. In fact, margins here are non-existent. They lose money on streaming. The margins are improving because they are raising prices and are reducing costs. The margins are going up, and they will probably be profitable soon. But the issue is they cannot replace the linear networks. You cannot compensate the huge amount of revenue Disney got from linear with direct to consumer. The margins just cannot be the same. 1 year ago, while linear was already in decline, they had around 30% margins here. You don't get that in streaming. Even Netflix, the best one of the streaming services when it comes to operational performance, only has an 8% operating margin. Could you believe Netflix would ever reach a 30-ish percent margin? Not the biggest Netflix bull would ever say that would happen. So when people say, oh, the parks are doing okay and streaming is already getting profitable for Disney, so they will turn around, that is just not how it works. The issue with Disney is this dying media business, and that they cannot replace the profitability. Yes, they have stuff like ESPN here. They have stuff like Hulu. And ESPN especially is probably gonna be a more valuable asset because of the sports betting they're getting. But it just cannot replace the entire linear sector. And especially because Disney subscribers are flatlining right now with the price increases. But I actually prefer that. Growth at all costs is just gonna hurt Disney in the streaming business even more. While they have cut the dividend to say, oh, we're gonna deleverage, they have basically not deleveraged since they announced that. They have paid down 6 billion of net debt. In fact, their interest expense is already 1.3 billion, and it declining recently is not due to them paying down debt, no. That's just that they have more in cash, so they get more interest on that, and the debt has not rolled over yet. But when this debt will roll over soon, this can go up even further. While the business has been performing horribly on a fundamental basis, share-based compensation, since let's say 2018, nearly 3x. While their free cash flow is only 2.8 billion right now. So realistically, right now you're getting $1.7 billion of free cash flow on Disney. In 2016, you had maybe like 8 billion after stock-based compensation. Is the free cash flow down because the income is down or because of CapEx? CapEx is mostly flat. Disney has always spent between 6 and 3 billion per year on CapEx. That has not really changed. CapEx is not elevated right now. They did put out an announcement recently saying that they will increase spending on parks, but honestly that is needed. They need more attractions, otherwise people will not come at these sky high prices if you do not put in some extra investment, and you also need to keep the growth up. The park segment needs to be growing. It can't just be stagnating. For that, Disney is way too highly valued. So now the question, where is Disney's free cash flow gonna go? Because it's not gonna go away, the parks are profitable, the streaming business is also gonna make some money eventually, and this is just a game that is very risky to play. While yes, probably the linear business for the next few years will maybe spit out $1 billion of free cash flow, but they're also trying to sell stuff off there. So you just really don't know where it's gonna go. Let's say the parks make around 10 billion per year in cash from operations. Plus streaming will get profitable and add another billion. and linear will only decline to around $1 billion per year. Minus capital expenditures, a lot of this capital expenditure is in the parks, plus they will spend more money on streaming, so the capital expenditure will stay the same and actually go up in the plan they increase. So let's say they have $5 billion of capex. That equals $7 billion of free cash flow, minus the $1 billion in stock-based compensation. So realistically, we come to $6 billion in free cash flow, back to the levels of 2014. That is a very conservative assumption. Obviously, let's say streaming is a bit more profitable. We come to $7 billion. Let's say linear stays for longer. $8 billion. But Disney is still trading at $150 billion market cap. That is still a 19 times free cash flow. While Disney is a great company, those are very optimistic assumptions. And that also includes that the planned capital expenditures 101 translate into operating income each year, where we take streaming profitability with high margins in the next few years, linear to not decline much further, and for parks to continue growing like they always did, and eventually the price cap is reached. Disney price inflation has been crazy. They cannot continue this forever, otherwise no one can afford to go to Disney World. And I'm honestly gonna say, while it's a great company, I don't think the risk-reward ratio is to my advantage here. Well, yes, the downside is limited with the parks. The parks are not gonna go away, but I think they're just better placed in the market right now. And also with the increased investments that they announce into the parks, they won't have the money for a dividend really. And if they pay out a dividend, that is very bad, because that debt needs to be refinanced already, and that will go into higher rates. They're already at $1 billion in interest expense. What do you think about Disney? Write it down below. Thank you for watching. Have a good day.